Hit it. It's Friday, September 22, 2023, episode 222. I'm Patrick Serezna.
And I'm Kevin Muir. This week, Warren Pies from 314 Research joins us to talk about how shale changed the entire macro landscape, what the bond and stock market is priced in, and where they might be wrong. Then Patrick spits out a mouthful of crayons to tell us what he sees in the charts for the next couple of weeks.
And then we end with no stupid questions and skin in the game. And folks, stick around. We might even drink some beers along the way. Lena, hop on. What beer are we drinking this week?
So this week, the gents are drinking Dewclaw Brewing's Dirty Little Freak Coconut Caramel Chocolate Brown Ale.
Ooh. Actually, it's just Patrick and Lena. It is lunchtime, and I have to trade this afternoon.
Oh,
so
wow.
I'm just going to read a little description here for
please.
this beer. There's no safe word. Respect a fluid. A dominant blend of roasted malt, coconut, caramel, and chocolate essences, barely restrained by a gentle hop bite that tantalizes your senses all the way through to a satisfying finish. Submit to indulgence, but be warned, there is no safe word.
Holy smokes, I'm actually upset I'm not drinking now.
Oh, wow. It's actually really interesting. Like the coconut really pops out. I've never had a beer that had that kind of a taste. It's pretty interesting. All right. Anyway, I'm going to enjoy the beer. So let's get to our guest. Oh, no, we're not going to get to our guest. Give us some side effects,
too. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the value ventilation, the prop trade poops, or the yield curve canker sores.
I took a sip and just...
Okay, now let's get to our guest. It's our great pleasure to welcome to the show Warren Pies. He is the co-founder and strategist for 314 Research. Thanks for making time for us today, Warren.
Absolutely. Thank you for having me.
I've been looking forward to this, and we've been chatting a little in the pre thing, and it's already, I know it's going to be a lot of fun. And so for those who don't know you, let's kind of go over your history and your background a little bit so that before we talk about your shop. First of all, where did you grow up, and did you always want to be in the markets?
Well, I would say that my path is a little bit circuitous and different. I grew up in Florida, so in the United States, and in Florida is not necessarily a hotbed of finance activity.
It is now. You shouldn't say that. It wasn't when you were growing up, but it is
That's
now.
true. I mean, it's at least it didn't feel like it at the time, but. So that I grew up in Florida, and my career was really I started out as an attorney. Went to the University of Florida. I was an attorney for a few years.
Okay, Warren, I'm not going to let you off without going through your background on the Florida. You told me something. You told me that we could talk about it. So
let's get all the secrets out on the table. Let's get it all out on the table. Yeah, no. When I say that I came from a non-traditional kind of starting point from this industry, hopefully maybe it gives somebody hope out there who's listening. It's like, I'd like to break into this industry and my background's not what it should be. Like, that's exactly me. So my family was actually carnies. That was their original business. And so that was the feeder that I came from, was a family of carnies. And when I say carnies, like they would take my dad and my grandfather, they would take, and this goes back, I'll give you the quick background because everyone's probably like, what the heck? My grandfather was a USDA meat inspector. And the story I was told was that at some point he went to a slaughterhouse and he came across this massive steer and he asked to buy it from the slaughterhouse, and they sold it to him. He started taking it around to fairs and charging people like a nickel to see this world, what he called the world's largest steer. And they accumulated animals from there. And that was what they did. And so that's the background. That's the true origin.
So when you say animals, were they all farm animals, or did they get exotic at one point?
They had a gator. That's about as exotic as it got. They had the horse, a steer, a pig, miniature horses. I mean, it was a whole thing. And that was legitimately their business. And so they were out on the road traveling and bouncing around the country, traveling, going to fairs and getting people to pay a nickel a dime to come look at these kind of freakishly sized animals. So that was it.
And did you grow up doing that?
I did a little bit. I did. I would spend the summers at at the state fair and like shoveling the horses, horse manure and stuff like that, and like taking care of the animals to a certain extent. And that was I can still recite. They had a tape that would play on loop, and you would sit out front and take the money from people, and I could still recite what that tape would say, because I would sit out there and listen to it and take the money. So yeah, that I did when I was younger.
All right. So you decide that I don't want to be a third generation carny, and you head off to school. Where do you go?
University of Florida. Went there for undergrad, went there for law school.
Okay.
And I didn't really know what I wanted to do with myself. I did get into the markets really in law school. It just was like a fascination of mine. And it really came again from my dad. He didn't have an education. Like I said, he was a carny. And, but he would put it in my head a lot as a kid. Like he would look through the paper and look at the stock market tickers and watch CNBC and just tell me, I think there's something here. Like, this would be really important if I could just understand this, I feel like we could make money. And so I'm pretty sure that put it in my head. It was just the seed that, just constantly was growing. And it really took hold when I was like in my early mid-20s in law school. And that's when I started with the as a hobby really at first.
And did you actually practice law?
I did. I was a lawyer for 3 years or so. It just wasn't for me. It was in land use. It was kind of it ended up being a good thing for me because we represented the phosphate mining industry, the firm I was at.
Okay.
So we were into the commodity business. And when I went to Ned Davis Research, which was the next place I stopped after I decided to change careers, from being an attorney, I went to Ned Davis Research and got into the commodity team there. So I started out at the ground floor as a commodity analyst and was at Ned Davis for 10 years. I got to play with a lot of data and test things. And eventually, by the time I left, I was the head of the commodity team. So it worked out for me there.
So what made them, take a shot on this lawyer that decides that law isn't for him and, he really wants to be a commodity analyst?
Man, it was luck, a little bit of luck on my part. Life does take, you do need to get lucky a lot of times. And I'm grateful and humbled, honestly, sometimes when I look back on how things went. But I met a guy through my law practice and I took him out, and he used to run a hedge fund in St. Petersburg, Florida. Matador Capital was the fund name. And he's still one of my best friends in the world. He's a bit older than me, but I took him out to lunch. I said, I want to switch careers. Is there any way you can, I need to stay in this area. Is there any way you can get me in at this firm, Ned Davis Research? So I identified it as a place I wanted to go. He's like, I know one guy there. He used to work with me at Raymond James. And so he made an introduction for me. And so I met this guy, John LaForge. John, still really good friends with him, play fantasy football with him. Still to this day, he's the head of real assets over at Wells Fargo right now. And John and he gave me a lunch just as a favor to his friend David, that was our mutual friend. And eventually, I just badgered him. I wrote fake reports on commodities and oil and showed him what I thought was important. And they were looking back, they were really kind of humorous. But this was what I was trying to do, and I think he just saw that I was really interested, and I had a lot of, and I could write, from being an attorney. And so I think he saw that, and John was crazy. No one else at that firm would have given me the job. John was definitely unconventional, and really appreciate that he was able to see something in me. And so he gave me an interview, and rest is history.
I would agree. I just, read some of your research reports, and you're a fantastic writer. Do you attribute that to law school? Did you learn that at law school, or do you think that was just a function of, a skill that you were always partial to?
I do think it's something you learn. I just like the analytical skills. And it's all driven by kind of just, you got to like what you do. And so, yeah, law school is a lot of writing. It's kind of like an English degree on steroids. And then there's logical reasoning. And that kind of does, I did run away from that. I used to tell people I don't use anything that I went to school for, and it was all a big waste of time. But in truth, there probably is a good amount of base level skills that I learned from, and I wouldn't recommend that as the path to take for anyone to do this, but it did work out for me, and it's helped me out. Yeah.
All right. So you join Ned Davis, and you start off as an analyst, and you're working the commodity. And can you tell us, so first of all, what year is that? Is that like early 2000s?
Yeah, that was 2010.
Oh, not late, mid 2000. Oh, so you're You're a youngin.
Yeah. So I was, when I switched careers, I had my interview with Ned Davis Research on my 30th birthday. So it was a real mid-career shift, it was a real thing. And then you're probably wondering, well, how did it go from there to this? And I wonder that myself sometimes, but the big break for me was at Ned Davis, there was nobody covering energy at that point. Energy was it was before shale had really taken hold.
Okay.
And so they had kind of said, you need to figure out, it was a great opportunity really, but no one was picking up energy or materials. So I picked those two sectors up and I really worked to understand all the subsegments of the energy space. And that's what started it. And when I kind of got exposure or kind of got a little bit of momentum outside of just the little Ned Davis world, because I wrote the first piece of research at NDR on master limited partnerships. And that was in 2013 by this time.
Right. And
that research note, the editor at Barron's somehow came across it and loved it and asked me to do the MLP roundtable, the Barron's roundtable. And that was a really good break. And so from there, I kind of just, I went with it and continued to build out my energy knowledge. And by the time I left, I had really spent a lot of time getting to know oil as my specialty. And I think oil is really central. It's sneaky. If you can understand the oil market, it really gives you a leg up on your typical macro forecaster. And so that's been good at 314. And it's been really where it was my bread and butter. By the time I left NDR, I was understanding the oil market.
I'm just thinking back, and during the 2000s, obviously commodities were big with China growing and stuff. It was commodities were it. That's what everyone talked about. And I'm just trying to remember, was oil just kind of languishing and not really the commodity that everyone cared about? Like, why did Ned Davis not have the someone doing energy?
Well, it's a weird type of firm to get into the reasoning. But John, the guy who was the commodity, they didn't even have a dedicated commodity team until John started it and I don't know what year that was, probably 2008 or so. And so it was right on the tail end of all that. And John really was a gold guy. Like that was his expertise. That was the area that he was known for. And so he focused a lot on precious metals, and that kind of just left this whole void of oil and energy.
Okay.
And I took it over. I don't think that he necessarily meant to give the whole thing to me, but it just so happened that I did a good job with it, I think, is the honest truth. And then clients wanted to hear what I thought. And I, started traveling and talking to different people. And that was kind of how it happened.
So what's kind of, obviously America's energy stance has changed a lot during that time. And you mentioned the fact that shale was just starting to get going and things of that nature. What is your thoughts about how that is changed in terms of America's reliance in terms of their macro situation with other countries and with other exposures, meaning that in the past, a rise in oil would often hurt the country, but now all of a sudden it might not be so. I'd love to hear your kind of bigger picture thoughts about how shales has changed America's kind of footprint.
Yeah. Well, number one, like you said, I think it's given us more capacity to be a little bit isolationist in our foreign policy, so that you see that bubbling up in popular politics now. And I think that's really a result of shale giving us that latitude to even consider stepping back from some of these foreign entanglements that defined the pre-shale era. So that's definitely an aspect that just causes us to be we're more self-sufficient. And so to the extent that we can, embark on trade wars and things like that it gives some latitude. The big thing that I've seen, and it's something we've hammered with our clients at 314, is that I really think shale was one of the two major disinflationary forces that changed market structure from, say, 1998, 2000, all the way into the pandemic. And that along with globalization, but globalization kind of happened first, and then shale came along. And we have this chart that we show clients. It's just basically the Fed's 2% inflation target and what CPI actually did. And then we have the price of oil on the bottom clip. And really, you know, shale came onto the scene in that right around the time with me moving my career. So I followed it along. And then 2014 is when the Saudis had enough of shale. So they decided to engage in their first round of the price war. And that pushed the price of oil much lower than it had been in the growth environment. So a supply-driven decline of oil. And if you look at that chart of CPI and target, that was when CPI really deviated from that 2% target, and the Fed was constantly fighting to hit that 2% target back then. So I think it's been, and then just stepping back to finish it all off, like, what does that mean for investors? Well, when you take inflation out of the equation, it causes the stock bond relationship to go negative, that correlation between stocks and bonds, which powers the 60-40 portfolio, where that whole pattern we know, stocks go up, bonds are cushioning you on the down and getting a bit on the downside. We aren't seeing that anymore. And so I think we've changed that. But during that market structure, 1998 to 2020, you had globalization and shale as those two huge disinflationary factors. And I think it was just, you can't even, it's hard to measure the impact on America and within the finance world on portfolios.
That's a great point, because everyone talks about the globalization, but few, mention and put that kind of importance on shale. So I think that's awesome. Before we go on to your other views about the market, and we'll expand on that, let's just go through your career a little bit and finish it off. So you're at Ned Davis. You've been there for a while, and eventually, I guess you decided it's time to go on your own. I'd love to hear the story about how that came about.
So that's a choppy story. It was so Ned Davis Research had been bought out by. I'm just going to be honest. I guess it get me in trouble. I'm going to tell the safest, honest version I can.
Okay.
Ned Davis Research bought out by a private equity company. They were looking for ways to make a new revenue. In 2019, they had suggested selling my research separate. And we had a whole company offsite, and I begrudgingly agreed to that. So at the time, Ned's stuff was sold separately, and they were saying, hey, we'll sell Warren's energy oil work as well. And I had said, okay, I'll do that, but under a certain set of conditions. And then in the process of fulfilling those conditions, that we kind of got sideways, myself and management. Okay. So I said to myself, if I'm going to do this and write this whole thing on my own, let's do it the way I want. It's kind of a regret minimization thing. Like, I don't want to do this. I don't want to have my name on a product and have someone else dictate how it looks, how it feels, how it's priced, all that stuff. So, I did it myself. And that was how really I was motivated to start 314 Research.
And so you went off and you grabbed Fernando. Is he also from Ned Davis?
Yeah, I did. I grabbed Fernando. We met at Ned Davis Research. He was actually he worked in the custom research department for many years over there, in the data department over there. He actually helped me on that MLP research piece that I did back in 2013. So we had collaborated before. And then he left, went and got an advanced degree in machine learning.
Oh,
and then went on to work in the tech industry out in the Bay Area. And so that's what he was doing for many years. I think he left NDR somewhere around 2015. And so by the time we had synced up, he had a whole nother life and career going. But he always, I think in preview, you're going to ask me probably what my favorite finance book is. We both read the Jim Simons autobiography, the man who beat the market, or whatever it is.
Yes. Yeah.
I forget the title, but we both read that around the same time, and we would be talking on the phone about it. And I think we're both data guys, and we really enjoy trying to find things that work, constantly testing things. That was what we did at NDR, and he would still do it on his own time. So we read that book at the same time and would talk about it. And it really fired us up, and he was fired up to try to keep moving his career in finance forward. So he was my first draft pick once I decided to do this.
I like that. So can I ask, I love your charts. Do you guys do those yourselves in R or Python, or are those from Macrobond or something? Because you probably have one of the better looking charts out there.
Thank you. Yeah. Well, we do that in Python. We also have markups that we add. I think anything, my goal, like you said, there are lots on the writing and the research because of my background. I like to write. I like to try and make it interesting and thoughtful, but truthfully, everyone's busy. And if we can tell 80% of the story just through the charts, then that to me is really what we should be doing and letting the charts tell 80%. So yeah, we spend a lot of time on the look and feel. It's Python based. And then we have a markup program that we do called InDesign that we add the markups on the charts. So it's a two-step process.
All right, so let's chat some markets. First of all, I just want to start with telling you that I saw you get on Twitter in real time and highlight buying crude oil. It's got to be 3 months ago, and you had a great reason. You had some great data to back it up. I'd love to just hear what that reason was and why you recommended that back then, and then we'll talk about where your stands now.
Yeah, I appreciate that. Starting with the good call. Yeah, so a few months ago, everything's model based and quantitative for us. So I have an opinion on things, but we really try. I think that your ego can get in the way, especially as like a public commentator. If you're known as a oil bull, I hate being labeled one thing or another, because then all of a sudden it's your ego.
You can't change, or it gets tough to change.
Exactly. Yeah. And that's, you box yourself in. So I don't want that. So we really do try and use our models to call crude oil. And back in very early July, we could actually it started in late June. I could see the model was going to change because I've built it. So I know how it's going to work. And so the bottom line is you have the Saudis back there holding oil off, or about to hold a lot of oil off the market along with OPEC. And really coming into the year, the story across assets was everyone was prepared for a recession. And you see this in the oil market as well. So we watch hedge funds and CTA positioning in our model. And so hedge fund CTA positioning, short positioning in the oil market had grown to the highest level we've seen post-COVID. And that was late June, early July. And so I could tell, given what was happening on the supply and demand side in the physical market and we really didn't see a recession coming in the United States. So we were pretty confident demand was strong. Supply was being held back by the Saudis. So all we needed to do was have that spark to light all of the positioning tender that was in the market. And so that's what happened is we started seeing draws come through and positive improvements in the physical market. And that forced these short sellers who I think were playing for a recession out of their short crude oil position. And that has been the fuel for this rally. It's pretty much spent at this point. But that was the setup. We had that combination. Anytime you can get a combination where you're confident there's a deficit in the market and negative positioning, bearish positioning by hedge funds and CTAs, that is like a layup in the crude oil world.
And what I liked about it as well is you showed, it was, I can't remember the exact stats, but it was something like when this happens, and then it wasn't just a matter of it going to that number. It's when it moved back up. When it started to we had all these shorts, or we had a net short. And then when it started to move back up, you said, X percent of the time it's Y percent higher. And I thought that was terrific. It was a great call. You went out there and you were spot on. But what's interesting is, we've talked a lot about all your calls on crude oil and stuff. But when I read your research, it's like, this is full on macro stuff. And yes, oil is important. It is the biggest commodity, but there's tons of macro stuff there. And you've had a terrific call over the last few months as well, with the idea that you shouldn't own bonds and you should own commodities. And I know that you've recently changed that, and you've kind of gone to a more kind of neutral stance, if I read it correctly. But before we talk about that, let's talk about why you felt like a few months ago that you shouldn't be owning bonds and you should own some commodities, because as you mentioned at the time, everyone was owning tons of bonds and everyone thought the commodities would go down. And yet here you are doing the exact opposite call.
Right. So we know the commodity side, like, as I just kind of laid out, that having such a strong base in oil allows us to kind of work from that and build out our portfolios and recommendations. So you can see what's happening in oil, that asset's priced, but you're like, we're going into recession. So that's number one. And we don't, in our base case on everything is we didn't see a recession happening this year. And then on the other side, bonds were priced as if we were headed into a recession, or at least we needed a recession, it seemed, to make sense of the pricing that we were seeing in the bond market. And so these were the two most mispriced assets from the major assets and from our view. And so, bonds, we measure valuation off nominal GDP from a term premium basis. We, some basic back of the envelope stuff like what's the typical 10-year spread to the Fed funds rate, and where do we expect the Fed funds rate to settle out at the end of this cycle, and things like that. And from every angle, and then you can also talk about I think it's kind of old hat at this point, but the massive issuance that's coming in the back half of this year, and the fact that essentially the Treasury was able to spin down the TGA and hold off issuance through the first part of this year, which I think confused markets a little bit. Right. So all those things came together. It made us think, look, this is not a very good time to be in the bond market. This is the story we talked about. There's recession pricing throughout the markets, and it has to be unwound. So it was unwound on the bond side, and obviously it's been unwound on the commodity and crude oil specifically side of that trade. And so that's what we saw coming into Q3. That was like the very end of Q2, so late June, when we started making those positions. We actually positioned for it in early June, but that's when I think it really heated up, was late June.
And let's talk. Oh, sorry, I didn't mean to interrupt you.
That's good. That's fine.
Okay, so I was going to say, I'd love to kind of try to understand, or at least get your opinion about why the market was so convinced we were going to have a recession. Because let's face it, this has been the most anticipated recession that we've ever seen. And it ended up hurting a lot of folks because people were so far ahead. And I might even argue that the fact that they were so far ahead kept the curve inverted and kept long rates lower in yield, and might have actually put off the recession that might have happened had rates gone up.
I totally agree with you. And that was something we started writing at the end of last year, or in the beginning of this year. If you remember, we came into the beginning of this year, everyone was looking for a recession. And we actually said in our year ahead outlook, we think that the theme of 2023 is reflexivity, and the fact that everyone's trying to front run an outcome. And by front running an outcome, they're going to prevent that outcome from occurring. And of course, there were a lot of things going on, but that was, to me, the summary of what the setup was coming into the year, because there's such a consensus on the recession trade. And what happened, in my view, is that especially at the end of last year, you had, because if you remember when stocks hit their trough in October, mortgage rates specifically were peaking back in October. And then you had, of course, set aside the fact that the Treasury stopped issuing coupons. But essentially, at that point in time, investors saw the disinflation trade, and they started playing for it in the bond market, that muscle memory of just buying bonds.
Yeah.
So they were buying bonds, which pushed down the long end. And at the same time, the Fed's hiking the short end. And you had this kind of, for this moment in time, an inverted yield curve was actually, when it's moving in that direction, in that environment, was actually stimulative to the consumer, because you have the consumers on the high end, especially, is positively geared towards higher short-term rates, which is interest income for them. And then on the back end, borrowing costs on homes and cars and things like that were falling. And so it was this weird environment where the inverted yield curve was kind of stimulating the consumer. And that was what we thought. We saw it in car pricing and mortgage applications and in the housing market as well. So that was part of it, for sure, is this idea that everyone's front running disinflation. You can't have disinflation when everyone's front running it. And
you mentioned there, you said something about the fact that the front end higher is actually stimulative and that more interest income. I happen to agree fully, and I've been arguing that you could make the case that actually Powell raising rates has been stimulative to the economy, not restrictive like everyone thinks it has been. I'd love to just kind of understand why you agree with that, why you feel the same.
Yeah, I mean, this is something of the MMT guys, and I think they have a lot to offer, a lot of interesting opinions. I've spoken to Warren Mosler about this, and I know he really takes it to the next level. But basically, the idea is that if you hold everything else constant, if short rates come up, you don't borrow on the short rate. This is just my basic, Florida man thinking. You don't, the consumer doesn't borrow on the short end. They're putting that money in savings accounts and money market funds, and it's generating income for them. The economy runs basically, the financing economy runs on that 5 to 30 year part of the curve. And so if you're just raising the short-term rate, the Fed funds overnight rate, then you're actually, if everything else is held constant, and that's all you do. And that's never, nothing's ever held constant. But if you just think of that as the world for a moment, all you're doing is giving more interest income to the consumer and stimulating the consumer. I think that the MMT folks say it's also blowing out the deficit. So it's causing the federal government, which is ultimately just paying into consumer savings, to widen that deficit and increase their expenditures into the economy and stimulating on that channel too. So you have the interest income channel that's being stimulated. And, I think the assumption whenever the Fed raises rates is that you're also going to see long rates back up and borrowing costs. So you would have the borrowing channel would do the tightening work for the Fed. And clearly, if you're seeing borrowing costs come down while interest income is going up, it's not really working how it's supposed to on the textbook hike cycle.
Yeah, and I guess the way I kind of talk about it is the idea that the government is a net debtor. That means private sector's got to be a net creditor. And so when they go and they raise rates, that means they pay more interest. And unless the government pulls back on spending by the amount of the interest, and in fact, they're doing the opposite, they're spending more, then actually you're putting more money out there into the economy.
And that's something we pointed out is like, if you really think about it from a big picture, there's really two ways to create money in this economy. You can, the federal government can spend it into existence, and then you can create it through the banking system as new loans are created. And I think the inverted yield curve, like you ask, why were so many people wrong-footed on the recession call? I mean, the inverted yield curve, it's treated as a prediction. I don't think it's a prediction of a recession. I think it's a causative agent. And so it's because it basically turns the modern banking business model on its head. And so that in a normal cycle would starve the economy of money creation. You would see banks pull back on lending, which is by definition a reduction in money supply. But we've never been in a world where you have the government running these massive deficits, 8% plus of GDP, while unemployment is this low. We've never been in this world. I call it a pro-cyclical deficit spending. So you're killing the banking system right now, but you're not killing the economy because you still have the federal government on the fiscal side spending all of this money into existence, if that makes sense.
Yeah, no, it does. And you have a great chart in one of your packages where you actually show unemployment versus the deficit. And it's usually, a cluster, and you can see a relationship. And then we just have all these abnormal sections where, the deficits are 10, 15%, and it's all kind of post-COVID.
Yeah, we're off the map. Never been here before.
And the other thing that I think is interesting that you touched upon, you talked about the TGA, and obviously the RRP is another one. And I don't think people appreciate how big that RRP is and how much that can, push or, withdraw money from the financial system. And if we think back to the spring, everyone was expecting the TGA to go up, for the RRP maybe to go down a little bit, but not that much, and for there to be QT, and we would have kind of a withdrawal of liquidity. And that was the base kind of case for the bears. And yet what we saw was the RRP went from whatever the number is, and it declined by $1 trillion or whatever it is. And it ended up being that liquidity has gone sideways in this period. I would just love to kind of get your opinion about the RRP and whether it makes forecasting, like, first of all, do you think it's as big a deal as I'm making it out to be? And then second of all, does it make forecasting a little more difficult?
Well, I think that liquidity is like this. Of course it matters, but it's really so difficult to measure. And what I find is, like, during periods of uncertainty, that's like kind of a fallback term for a lot of people. And it ends up being one of those, I feel like it's one of those bricks in the wall of worry that the market just always happens to climb, because I don't know. It's just it's a little opaque to me. I do think that it's a big deal though, the RRP in this cycle, and specifically because I like to simplify things. Like in QE, even when QE was going on, we first started 314. It's a totally different regime. We tried. There was this debate: is QE? What is it? Does it do anything to the economy? Our whole focus has been on duration. It takes duration out of the market, and so by definition, if it's taking duration out of the market, like in all else equal, it's stimulative. QT is putting duration into the market, assuming the Treasury is issuing duration, which is a whole nother argument and conversation. But let's just say QT is putting duration into the market. And the reason I think RRP is so important is because the argument from the Fed side is that we will stop QT once we hit to a certain limit on bank reserves.
Right.
And for a long time, it was debated on whether RRP would be treated as collapsed into reserves. And if it is, like you said, there's a lot of money there, then QT can go on through next year, basically. And if it's not, then you basically have QT would probably be done here in short order. And so that's why I think it's a big piece of the liquidity puzzle. If you only look at bank reserves and don't consider RRP, which is what the Fed's doing now. If you listen, like Fed Governor Waller was one of the first to really talk about this, then you miss the big picture, which is that there's ample reserves in the system. It's just how are they getting priced, through and really the loser and all that is the banking system and particularly regional banks. So.
Does it frustrate you that the Federal Reserve uses QE as a policy tool, but then refuses to use QT as a policy tool, meaning that they'll sit there and they'll crank up the arc of the QE when we have a situation where the markets are in trouble, but then in terms of once inflation comes, they won't use QT and they'll be like, no, we're on autopilot. We wouldn't dare dream of using QT as a policy tool. We're going to rely solely on interest rate hikes. Do you think that's a mistake?
I think it's a mistake. It doesn't frustrate me, but it is a mistake. It's a mistake if they're trying to tighten policy. QT is the most impact, just for the reason we just said. Hiking rates on the short end is just not going to do the job in this world. They're going to need to impact the long end. I think that it makes sense to proceed carefully with QT because that's when you could have a hiccup here or there. But they've been pretty hesitant to do outright sales, for instance, versus just letting the balance sheet roll off. And I think that my base case is that they were going to need to do more work on the long end through QT in order to slow the economy. Now, they used the other potential tool this week with the dot plot and basically their forecast, which was more effective than I expected it to be. At least in the short term. But that's another possibility.
Well, why do we talk about that? Why do you think it was more effective?
I wish I could say I know. It's why is this the thing that this is the time where the market really got the message of higher for longer.
It was like finally when it's there in black and white, the market had to realize it. And it was funny because it was just arbitrary that they had to go to the next year.
Yeah, to me, what we've been looking for is that long running dot, that terminal rate to come higher, and it stayed at 2.5, which I think is inevitable that's going to go higher. And last time that went up is when the markets really threw a fit in 2018. But I think the main message that got the market, if I had to guess this time, was the fact that the Fed forecasted real rates to be higher in 2024, and so. The big hope, the equity markets are priced for a soft landing for sure. And so the big hope is for the Fed. And what we've done on the soft landing question is what's the ingredients for a soft landing? Number one, you need disinflation, which we've had. And I think we more or less will continue. And then you need a hyper-reactive Fed. So if you go back in history, most generously defined, there have been 4 soft landings. The longest Fed pause from peak rate hike at any soft landing was 7 months. And so I think that in most of the time, it's like they turn around and cut as soon as they're done hiking for a soft landing. So the bottom line, you need the Fed to be hyper reactive to generate that soft landing. And that higher real rate in 2024 sends a clear message that we don't really care if CPI rolls over for 3 months or 6 months. Like, we're going to let real rates, which is just interest rate minus inflation, we're going to let real rates stay high, i.e. we're not cutting rates just because of inflation. We need to see some durable damage to the labor market probably in order to start cutting rates. So that was if I had to guess, that was the part of the dot plot and the projection that really got the market's attention.
Another part where you wrote recently in one of your pieces was about the 1 year forward rate. Why don't you explain to us your thinking there and how that kind of, how you compared what they were expecting in terms of the stock market versus what they were expecting in the bond market?
Yeah, to me, that was the chart of the year of if you needed one chart to understand what's going on in markets, is that we have a chart showing on the start, the easy part, earnings for the S&P 500 through 2025. You're up 12% from 2023 through 2024 and up another 10% in 2025 in a perfectly straight up and to the right glide path for earnings. So that's your top clip in the chart. The bottom clip that we had was the current 1 year yield minus the 1 year yield 1 year forward. And so it sounds like a lot. There's like a million 1 years in that, but it's really simple. It's what's the current yield on a 1 year, 12-month bill, which is like 5.5%. And then you can imply or back out from the difference between the 1 year and the 2 year, what the market's implied 1 year will be 1 year from today. So the month 13 to 24 yield, that's the 1 year yield, 1 year forward. And the difference between those two numbers, the 5.5 for months 1 to 12 today, and then the next 13 to 24 months, the market was implying a 175 basis point reduction in the 1 year over the next year.
Which is crazy.
Off the charts. You can take a historical look back all the way through the 70s. Never seen that steep of a discount to the 1 year forward. And so very pessimistic outlook from the bond market. So you have stock market, perfectly higher double-digit earnings growth for years into the future. And the bond market is saying the Fed's going to have to cut rates unlike they ever have cut rates in modern times based on this 1 year yield, 1 year forward and what it implies versus the current 1 year yield. So that was the setup that we saw, that one of these two markets has to be way wrong. It just doesn't work. These two things don't align together. And so our view, and it kind of continues to be our view, is that the bond market would be wrong first and the stock market would be wrong later.
Got it. That's a good way of putting it. I like that. By the way, you're going to have like Sesame Street. I don't know. You're probably too young, but there used to be Sesame Street. One of these things is not like the other.
No, I did watch a little Sesame Street.
Okay, you did. Yeah. And they had that section. You can have that for your charts.
Yeah.
Let's talk a little bit about the earnings, because you have some great stuff in there about although the EPS has got all this growth priced into it, you have some interesting observations about margins. Can you tell us what you're thinking there?
Yeah, this earnings season I think was really interesting when you start breaking it down. So first off, let's start with the bullish part. We came through, we had highlighted this earnings season. If you go back and look at last year Q2, last year Q3, we came out of those earnings seasons with forward EPS estimates going down. So this is Q2 2022. We saw the 2023 numbers get written down by analysts coming out of that. And so we were worried that could happen in this earnings season. And in fact, what instead happened is we came out of this earnings season and 2024 estimates are going up by like $6 a share on the S&P 500. So that's a positive. No way to spin that other than a positive. When you break it down, what is, I think, unlikely to me is that 80-something% of that increase, 5 of it, the $6 increase in EPS, 5 of that is coming from margin expansion. And I just am skeptical that we're going to see margins go back to or go above 13% next year, which is, remember, 12% is the peak pre-COVID. So the equity market is pricing in a 13% plus, more than 13% margin on earnings next year. We're skeptical of that. I think the market is a little bit skeptical, or at least is nervous, because what we also saw in this earnings season is that stocks that beat the estimates were sold off And of course, everyone who missed their estimates, they were hammered, but almost the exact same pattern for stocks that beat versus stocks that missed in this earnings season. And if you break it down, I don't want to go on and on, but if you break it down even further, you can say, okay, well, what stocks did rise? About 30% of stocks in the S&P 500 did rally following their earnings report this season, and they had to really guide higher. So these stocks guided significantly higher and had estimates go even higher than the market did. And entering earnings season, they were about one turn or whatever you want to call it, cheaper than the stocks that were beaten up this earnings season. So the stocks that rallied after their earnings were at like 17 multiple, and the stocks that were beaten up following an earnings report this season was at 18%. Or 18 times. And so the bottom line is, I think everything's priced in. It was a big message of this earnings season was that everything was priced in, and the poster child of that price action was NVIDIA. And it really is telling to me what happened to NVIDIA after earnings.
I'd love to hear your thoughts on the Magnificent Seven and how that's made your job as a macro strategist more complicated.
Yeah, so very complicated, because if you miss those 7 stocks, every model you run is lagging. And so we have a quality based stock selection system, and it's quality and trend. We call it full cycle trend. And it's beaten the market the last 3 years, and is an equal weighted portfolio of 20 stocks. Really simple, and even that has trailed the market this year. I think it's up something like 8% now, which really probably should be benchmarking to the equal weighted S&P, which is as of close today like flat on the year. So it's a tough one if you're not really overweight or into those tech stocks or just indexing in general. It's a very difficult market. I'm grateful because Fernando is knee deep in the AI stuff. And so he wrote an AI intro report for our clients and made a really gutsy call on NVIDIA before earnings, and basically said NVIDIA is uninvestable at these prices. And
I'd love to hear what was the basis of that.
Well, his theory is that he took all of the revenues that were projected by analysts in NVIDIA's estimates out to like 2027. And then he basically, he could explain it better than me, but he basically calculated how many knowledge workers in the economy that would have to be displaced or could possibly be displaced by that much compute capacity coming online by the end of 2027. And his conclusion is that if NVIDIA hits the numbers that are baked into that stock, that you would have to basically have something like half of all service workers in the US be replaced by these chatbots or AI type of applications. And so it's just not realistic. It's not a realistic future. And so he basically said, no matter, we're not going to get there. And then, it's going to be a great near term, but when you get beyond this, like next 12, 18 month hump, there's probably going to be a chip glut. And so that was his basic thesis. There's a lot of moving parts there, but that's
very similar. I saw this great podcast with Scott Galloway and interviewing this New York Stern professor, Aswath Damodaran. Yeah. Oh, and he was like, he's a tech guy. He's actually a bull. Like, he's a growth stock investor, and he's owned NVIDIA. And he said, I sold it. He says, I tried to come up with, the thing's going to grow this amount. Let's assume they have, 85% or 90%. He made all these assumptions that were just so bullish. And he said, even when I did all those, I couldn't justify this price.
Yeah. The most interesting thing to me though, is whatever, I don't, that's above my pay grade. I let Fernando give me the guts of that, the fundamental story for NVIDIA. But what I know is that was an amazing quarter. So Fernando was on CNBC the day before that they came out with that, and he basically made his case, and it was received skeptically. And then the next day, NVIDIA reports, and they had all the analysts on TV. And the host even said, yesterday there was a guy in here who said NVIDIA was uninvestable, and they all scoffed. And this was after hours on the reporting. They blew numbers out. They guided higher. They initiated a buyback. You got everything you could have asked for as a bull on that NVIDIA call. And the stock rallied initially, but here we are today in the low 400s.
Scares the shit out of me, Warren. Like, it's everybody owns it. I saw some guy that said, I talked to, one of these pods, and he says that every group, even if they don't do semiconductors, are long NVIDIA. Like, everybody owns it. It's just kind of, it's going up because it's going up.
It's a classic news failure. If you're in that stock, you got everything you could have possibly wanted, and the stock price didn't go up. So what's your next move?
Yeah, that's Shapiro. We had him on the show.
Yeah, news failure. Jason Shapiro.
Yeah.
I love it.
Yeah. All right, so let's talk about your recent call, because you had you had a great setup in terms of you were staying away from bonds, you were long commodities, but recently, yesterday, you just made a shift. I'd love to hear about your shift. What prompted it?
Sure. Yeah. I mean, I think it was like we said going into. It's making calls like this. It's less about predicting the future. And it's more about understanding what's priced into markets right now. And so mid-year, recession priced into oil, recession priced into bonds. And that recession has mostly been wrung out of both of those assets. And so I think oil is much closer to the top now. As I said, if you look at the managed money futures, they're basically just like they were as short as they have been post-COVID. They're now as long as they have been post-COVID. Those positions haven't reversed, like we said. So we're not like bearish on oil. I just don't think there's a lot of upside for oil from here. Our target was $100 a barrel. I think we touched that, but we don't just blow past that. Things start to happen mechanically. So we downgraded our commodity position and put that weight into bonds, into adding a little duration into our portfolio. And nothing's really changed on the bond front. It's just the pricing's gotten better. And so I'm a big believer in the old, I think it's Jim Grant's line, there are no bad assets, there's only bad prices.
Oh, yeah. It's a great line, isn't it?
Yeah, I love that line. I mean, it's true. And so nothing's really changed. I mean, there's still a bunch of supply coming for bonds, but, the bottom line is you're getting in at 4.5% on a 10-year, let's say it's an 8-year duration. I mean, if we're going to go back to 5%, you still don't lose money on the cap.
That's the part that a lot of people are missing. Like, if you look, when you bought something at 2, all of a sudden it moved to 2.5, you need a lot more time to offset the rise in yield. And now with the current carry being so much higher, you can be more wrong than you could before.
100%. And so I don't think this is the top in yields. I don't think we top ticked it, but I'm comfortable. I think we're within a range of fair value now. For bonds, depending on how everything shakes out. And like, we have a chart where we show however many months it is until using Fed futures until there's a month where we hit a 25% probability of a cut. And that was in May. The futures market was expecting a cut within 1.5 months, 2 months. And now the cuts are priced out 9 months away. And so, we're just getting a better price. The forecast of the bond market is much more realistic now at this point in time.
Well, that's one thing I love about your research as well, is that it's not just some pontificating about macro. You're saying, like, it's all a matter of degree, but we're switching, and you're making actual calls. Like, you're saying, nope, this is our model portfolio of some sort, and we're changing it. And is that something you've always felt like was important to your research?
Absolutely. I think you need to. I'm a concrete kind of person, and so I believe you need to give concrete recommendations. And I mean, my start in this back, like I said, when I first got into markets was trading my own little account and losing money as my own tuition to the market. And that's still in me. And I've learned a lot more trading around and making actual moves and than I have just reading books, And so, and I know clients, ultimately they have money they have to put on the line. And so we're asking them to pay us money and pay attention to us. We need to give them more than just like, academic thoughts. We need to give them actionable ideas.
Okay. So now the final topic I want to pick your brain on is housing. And I take it you're probably, if I'm not mistaken, you probably think that the chances of a recession has increased versus your call 3 months ago or 6 months ago. And partly that's because of housing. Could you just kind of sketch out why you feel that way?
Yes. So We think that for a recession model or a recession timing, we really focus on housing. We think housing is the leading edge of the economy. It's the area where Fed policy is going to show up first in the economy. And so we model out when we'll see housing payrolls, residential construction payrolls start to decline. And what we found is that before each recession, you get about an 8 to 10% drawdown in residential construction payrolls. So that's our magic number. And everything, we work backwards from that and determine when are we going to get there. And residential construction payrolls actually did peak, it appears, in January of this year, and they are trending lower. It's not a dramatic move lower yet, but they are trending lower. And then within that, you basically have a few moving parts. Like, how do you get to layoffs in the housing construction industry? Well, you end up with the front of the funnel is starts, and then time to complete a house. Those two variables give you the amount of units that are in construction, and units under construction is a really great variable for predicting housing, construction, and employment. So we start with housing starts, and those have started to fall. Multifamily, in fact, was whacked this last week. The data for August came out. Multifamily dropped well below what our most recessionary forecast was. We have like a bottom 4% drop in month-over-month drop in multifamily starts. And I think that's a direct result of of lending standards tightening, rates getting higher, and banks being less likely to extend credit to these projects. So multifamily is kind of falling apart. Single family still hanging in. But when we mix all together, our model says basically we should expect a continued grind lower in residential construction payrolls. And again, 8 to 10% drawdown of residential construction payrolls leads every modern recession in the United States. So that's what we're looking for. If we continue on this path, I think we end up getting there sometime, let's call it Q2 of next year, something like that.
And do you think that's a recession? Is that your base case? Recession in the first
case? That's our base case, yes. And it's all through that prism. The whole strong opinion is loosely held. It's not just something you say. I think it's with this economy, everyone has been too early writing it off. And so I don't want to, there's still a lot of fiscal offsets and excess savings and things like that. And I could make a strong argument that we don't have a recession next year. But again, our tool and our prism is the housing market, and there's definitely cracks forming in the housing market.
Great stuff. All right, let's finish up with our questions. Let's start with your favorite investment book, and is it the one you've already named?
Yeah, the Jim Simons autobiography was a nice inspiration at the right time in our lives, in my life and in Fernando's life too.
You know what's surprising about that is that you're a macro guy. You tell story terrifically. You're well written. You're well spoken, and yet your guy that you're picking is a numbers guy who doesn't even probably know the tickers he's trading. Like, he doesn't know what the tickers he's trading does.
I like testing things. I think that's at the heart of like this idea that if you sift through the data enough, that there's this like little money tree that you can find that's hidden in the market somewhere. I love that idea. And that's what the story of Renaissance is and Jim Simons to me. And he started really late in life, which I related to that. I think he was like 40 years old when he started the fund. And so there are certain things that resonated with me. And it sounded the early days of Renaissance in that book, if I recall. It reminded me a lot of sitting around the office with Fernando and Vincent, who I know you've had on this show before. He used to work at NDR, and we would just sit around and we would test things and talk about things. And it was really great. It was almost like an academic setting, and that they kind of remind me. So it sounds at first glance like we don't have a lot in common, but
hey, did you get a chance to listen to Peter Brown, the current CEO of Renaissance Technologies, on the Goldman Sachs podcast?
No, it's on. I have it bookmarked.
Yeah,
we'll listen to it.
For those who don't want to, just go and take the time, because it's a terrific exchange, and they're so secretive, so you rarely get them kind of conversation with somebody from Renaissance. All right, next question I'm going to ask you is, let's start with maybe the Byron Wien surprise. So Byron Wien described a surprise as something that the market had assigned a less than a 1/3 chance of occurring, but he thought that had a greater than 50-50 chance of occurring next year. Do you have a Byron Wien surprise for us?
Margins won't be what they're forecasted to be on the S&P 500. I think that qualifies.
I think it qualifies too, because it sounds like they priced in a lot and they're expecting a lot. All right. How about the Don Cox? Don Cox, a good Canadian. He said that you don't invest on what's on page 1 today. You invest on what's page 16 on its way to page 1 tomorrow. Do you have a Don Cox idea for us?
The thing that's on the back page today that I'm paying attention to, I think is going to become more prominent, is the Russia's ban on diesel and gasoline exports that just happened.
Oh, okay.
I think that we're not paying attention to that, and I don't know if they did that as a policy decision or an operational reality, but in either case, I think it's something we're going to hear a lot more about in the next year or so.
Do you think that means diesel and kind of those things head higher here?
Well, in the short run, you have the ability to, probably, but in the short run, you have the Saudis and OPEC that can offset any failures out of Russia. But the dynamic that I think we forget really quickly is coming out of the war initially, myself included, there was an expectation that Russian production would fall with the brain drain of Western companies that left the country.
Yep.
And in fact, production's gone up in the months post the war. And now we're starting to see things like this. I wonder to myself if this is not the first cracks forming in Russian production actually starting
I get it. Okay.
What we're thinking.
I hear what you're saying. Are great traders or great investors born or made?
I would say it's like, nature versus nurture. There's a little bit of both, but I would guess more towards made. And it's really learning lessons. How well you have to put yourself out there and learn things, and then you have to have the right personality of humility to actually accept the lessons that the market's teaching you.
Well, you know what? I'm going to take that as what advice would you give to a young person starting in this business today as well? But we're not going to let you off without the question that the previous guest asked. So let me play that. Here we go.
You gotta pick one country to invest in for the next 10 years, not your home country. So if you're a U.S. guest, not the U.S., but what country would you pick and why?
There you go.
Oh man, I could go a couple different ways. I'm going to say Canada.
Oh, you're just trying to be nice.
It gives me a chance to talk about. I like the oil sands and the big cap guys up in there, and I think it's kind of a low key play on shale wells, kind of petering out over the next decade. And so, I'll go with Canada, Mexico, Bangladesh. Those are all possible.
That's great. I completely agree with you about the oil sands. It's a long reserve asset that's going to, you're not paying much for in terms of expectations. It's just a no-brainer in terms of the long term for me. All right. And let's just talk a little bit about your shop. First of all, before we do that, how did you name it 314? Oh, sorry. Wait, sorry. You know what? I completely blew that, Warren. I got to get your question you're going to give to the next guest.
Oh, yeah. My question for the next guest, if you weren't doing what you're doing and this, assuming that you're in this business, then what career path would you have followed?
That's a great one. I like it. All right. Okay. 314. How did you come up with the name?
Well, last name Pies. I didn't want to put my name in the firm. I see that plagued Ned over at Ned Davis for years. He couldn't really retire. I didn't want my name in the firm. So 314 is kind of a play on pies, and it's also a math, term, and we are very quantitative driven. So 314 Research.
Okay, great. So you guys are actually geared towards institutions, but it's not just institutions. It's also, RIAs and family offices and something like that. I mean, that kind of a client base. Exactly.
That's our bread and butter. I think we have some great hedge funds and sophisticated clients and large asset managers that people would know on the service, but we want to be approachable even for, I think a relatively sophisticated RIA. And so you defined our client base well.
So where can they get you? Like, how can they find you?
Come to our site, 314. It's the number 3, and then spell out 14research.com. And fill out the information there, and we will give you some sample research. And then we will, if you want to have a dialogue about becoming a client, we learn more about you and make sure you're a fit and you come on board as a client. If you just want to lurk and see some of the stuff we've done, follow me on Twitter at Warren Pies. And then there's also the the company handle at 3F_research on Twitter. And so those are the best ways to reach us.
Yeah. So if you're an institution and you're thinking about this, I highly recommend that you go and get it. As I say, great written, great thought process, good looking charts, terrific stuff. For the retail guys, go make sure you give Warren a follow. He's actually, you are there a lot. You spend a fair amount of time and you talk about a lot of things on there on Twitter. So it's great stuff. So Warren, it was a pleasure getting to know you. I really appreciate it. Thanks a lot for your time.
Thank you so much for having me, lending your platform.
Take care. All right, Patrick, it's time for talking charts. What do you have for us this week?
All right, let's quickly review the top 3 things we were watching last week or the last 2 weeks. We were talking those global PMIs, and they really continue to be very weak. They're all under 50 right across the board. And I mean, I think like the U.S. manufacturing or something came in a little above, but overall, the PMIs continue to be weak. How much weighting do you put on the PMIs in terms of recession?
Well, I think it's just one more kind of clue about what the economy is doing. But I do agree with you that the global economy is slowing. I mean, it's very evident.
Yeah. So number 2, the inflation numbers. What did you take away from those prints?
Well, I don't know. I don't think it was a big, huge surprise, Patrick. It was, we surprised a little on the upside. But in the grand scheme of things, I think the market's gotten a little ahead of itself in terms of expecting inflation to come in. I think going forward, it'll be super interesting because if you look at the curve over the next 12 months, you'll see that they expect inflation to be 2.4 kind of 11, 12 months from now. I'd take the over on that for sure.
Right. And the number one thing we were watching was the central bank statements, obviously FOMC, but also we had ECB with that rate hike and the Bank of Japan, which didn't do too much. What did you take away from all of it other than the super hawkishness?
Well, Bank of Japan was obviously a non-event. ECB surprised with the rate hike, although you could argue that the leak a couple of days beforehand, that should have been obvious. And then in terms of the FOMC, the market interpreted it hawkishly, but I don't know why they had gone ahead and assumed the Fed was going to be dovish. I think too many people were thinking that the last hike was in and the Fed was done. And I contend, Patrick, that the Fed is on a 12.5 beeps per meeting rate hiking kind of stance, meaning every second meeting they're doing. And I think that this just shows that we're still at that stance, and you got to be careful about running ahead and saying that they've changed.
Well, you know what? Right now, looking out to November, they're right now the CME futures are actually saying 72% that they remain unchanged. Only a 27% chance that they're going to raise. But you think that
that's at you. Now I said 12.5 beeps, meaning one every second meeting, but there is a little bit of a kink in that curve because they're anticipating a government shutdown, I think. So what's happening is that people are saying they're probably not going to hike in a government shutdown. And if you actually go look at the December, 36%. You'll see that the December is
36%. It's still though.
No, not for
December.
No.
Right here. I'll show you.
No,
I have it right here. Look,
WIRP.
It's this is the December 13th meeting. They're giving 57% unchanged, 36.7% that it's a bump, and they're giving on a 5% chance that it's two rate increases.
Right. Okay. So the thing about it is, Patrick, if you look at the WIRP on the Bloomberg, it's 50, but until yesterday's sell-off, that had risen to 60 or 65. I can't remember what it was. So they were pricing in for a little bit of time. Chances are they were going to do a hike in December.
Right.
And then what happened was, as they priced that in, risk assets came off, and then the chance of that, in essence, a risk-off event causing the Fed to be on hold increased. So therefore, that's what's happening there. But I still go back to the idea that if you look at what the Fed kind of governors are saying, the FOMC members, that 12 of them thought that we were going to have one more rate hike, 7 didn't. And until we see data or something that happens in the market, I think that the stance of the Federal Reserve is they're going to do one every second meeting.
Okay.
We're not there yet. You just go back and listen to him. He repeated it numerous times. We're still at the stage where we are going slower with our rate hikes, but we are still trying to reach the point where we're sufficiently restrictive.
There you go. And you know what, though? I honestly think that if you look at historically the way behavior of central banks is they usually won't change course until something forces them to change course. And so if you think about it, over the summer going into this meeting, really the market was almost no volatility. Everything was stable. Nothing crazy was going on. Why would there be a pivot? Why would there be any even change in tone? Like, I think that it's going to take some change in conditions for the Fed to change their language.
I completely agree. And I think that that's the part that people are missing, is that they are at 12.5 beeps a meeting. They are at one every second meeting. Yeah. And until something changes, they're going to stay there. Yeah. And eventually, you're right, they will get to a point where they'll be like, okay, we've reached it. We're at that point. It's like that justice that, what was the famous judge that says, I don't know how to define pornography, but I'll know it when I see it. Yeah. I think that's what we're experiencing here. They don't know how to define what'll cause them to pause, but they're not there yet, and they'll know it when they see it.
There you go. All right, so talk about the top 3 things to watch in the next couple of weeks. So I put number 3, did another leg lower in bonds start. We had the yields break out, bonds pretty much straight across, treasuries particularly, straight across the board, mostly broke their October lows. And let's put up a chart on this. Which one should we look at? You want to look at? Let's look at a few of them actually. So let's start with this is the 2-year note, and the 2-year note is probably the only one that didn't break to a lower low from at least the summer. And it did definitely break below its October-November lows of last year. But when you go 5-year, it broke to a lower low. The 10-year note broke to a lower low. The 30-year note broke to a lower low. Like literally right across the board, bonds broke. The thing is that while it's a clear downtrend, clear break, there's no turtle head formation forming just yet. And so the question to watch next over the next 2 weeks, is there another full leg down? Like, are we going to see this T-bond futures go down to 112 or 110? It's certainly a break. What do you take? What's your take on that?
Well, I think it's kind of amusing how when you used to be bearish bonds, you were labeled not cool. You didn't understand the doom that was occurring. Oh, wait a second, I got to do it.
Tonight at 11.
You just didn't get it. And now all of a sudden, those guys that were the doom at 11 folks are actually huge bond bears.
Yeah.
And to me, it's never that easy. I suspect that the turtle head formation is very much in play, Patrick, that it's going to go back. It's going to test it. It's going to be choppy. Bonds don't trade clean. They're not like currencies. They're all over the map. I suspect that we're going to see a lot of chop around these prices. Is my guess.
If right now, it kind of lines up with number 2, which is we have the core PCE price index. So talking inflation again, coming next week. And I mean, I really think everybody is getting nervous about the fact that oil's rising. And it's starting to trickle in. And the question is there going to be another inflation run? And I think that's why bonds are weakening. But, Kev, like to me, while there was certainly, commodity drivers and supply issues that drove inflation, there was also a very important thing that happened during 2020-21 in that led to that inflation was a huge expansion of money supply. And this time around, there isn't any of that. So the thing is that even though inflation can uptick, I just don't see, inflation going north of 5% with any momentum. Could we have a few months or a quarter where inflation starts rising because oil's ripping to 100 plus? Yeah, that probably will happen, but I don't think it's going to be much more than a few percentage points. What's your take?
I don't know, Patrick. These money supply arguments, it's so difficult with the hodgepodge of different Fed programs, all the change in terms of global liquidity, how it moves around. I don't buy that you can look at money supply and measure it properly. So when I hear the arguments that you can't have inflation,
but it is a correlated. Like you look at that chart, there's no denying.
But haven't the money supply folks been telling us that the economy is going to crash for the last 6-9 months because the money supply has contracted so much?
Yeah, but in my mind, there's a huge lag effect. Be right. No,
listen, I might be right, but it's
a lag. Like they're bad at market timing because they don't understand that that things don't.
Or maybe money supply just doesn't mean what we think it does anymore, and it's not that simple.
Yeah. Anyway, that's not the number two. The number two is that the inflation number's coming out, and I don't think that even though I think we could certainly have a little bit of an uptick from oil rising, I don't think that we're going back to I think we need to have something dynamically far different for us to go back to 9%. It's not something.
Listen, Patrick, we're not going to 9%. That's not in the cards. The question is, and this is the part that everybody misses about inflation. They all say, well, inflation's retreating, but don't forget, it's already built into a lot of these curves.
Yeah.
Like, as I told you, you go look at the CPI swaps market, and a year from now, they're expecting a CPI print of 2.4%. So if you're expecting 2.4 and we just sit here at 3, like, it'll be a situation where it goes down, but it won't go down enough.
Yeah.
And that's the part that I think that a lot of folks are missing is it's not the absolute change in inflation. It's versus what's expected. And I suspect, Patrick, that it's going to beat expectations and inflation is going to be more stubborn than folks expect.
All right. You heard it from Kev. And number one, we have the jobs numbers coming out, not next week, but the week after. And of course, with us already seeing these negative PMIs, everyone's asking the question as to when will the jobs numbers uptick? Because, do you agree with the statement that often in the past, by the time the jobs numbers or like unemployment starts to rise, it usually is already in a recession. Like it rarely starts to rise before a recession.
Well, I do agree that it's backward looking. It's the last signal that the economy is finally rolling over.
Yeah.
Right. And you could argue that this time it's even more so because there was such a problem with labor, companies getting labor, they're more likely to hold on because they remember that instance where they couldn't find labor. So it might be that it's even kind of stickier, meaning that they don't fire people until the recession's even more entrenched.
Yeah.
So I agree with you there.
But with that said, while you agree, though, my view, though, is that this isn't going to be the jobs numbers. Like this one that's coming up is not the one that's going to be the spike. I think it comes maybe later this year, maybe early in the first quarter, but I don't think that this September number is the one that's going to be the surprise.
Well, and I'll say one other thing, Patrick. I believe that the unemployment will show up first in other countries. For example, Canada. I think you'll see unemployment coming in Canada before the U.S. The U.S. is the
even
strongest
Germany.
economy.
Germany's got
it's the strongest economy for a whole host of reasons. And anyone that is looking for economic weakness in the U.S. should first be looking for economic weakness in other countries. And Canada is a perfect place to kind of keep your eyes open for it because economies are very much the same, yet the Canada is, it's more dependent on housing. It's more dependent on private sector credit creation. It has more people with more debt that is floating. All the reasons why, America is outperforming, Canada's almost got the flip of that. So if you were to say, I expect the economy to roll over, I'd say it's going to roll over in Canada, Australia, Europe first.
Yeah, I agree with that statement, actually. All right, so Kev, let's talk some charts, buddy. Let's start off. I have the S&P 500 continuous chart, but what's interesting is now that interest rates are where they are, these futures rolls kind of make this continuous S&P chart a little tricky, because when we rolled from the September to the December contract, it appeared back a week ago that the S&P actually made a little bit of a higher high, when in fact it didn't. And it looks like...
I have a question about that, Patrick. I don't mean to interrupt, but when you go to your technical analysis school or whatever it is, what do they say? Like, how do you deal with that?
Because most technical analysis is taught on stocks, it's not covered in conventionally. So you have to go and talk to a number of those that specialize in charts on futures trading. But I think the one thing that I think Chase will agree with me on, the easiest thing to do is to simply start looking now when you're doing your key analysis to the direct month. So here, for instance, is the December month. Now you can see it kind of has some ugly lack of data going back to 2022, but generally it's a cleaner chart for understanding the way that the price action actually behaved. And so what I want to observe here is two things. One, that little rally attempt over here during last week on the 14th failed to break out. And decisively in this post FOMC, we have broken, but not only broken, but we've broken the August low. And so this pattern that's been in place on the S&P basically since the October low of last year was a sequential series of higher highs and higher lows. It's been basically an accumulated market. And this is the first sign that we're getting heavy. Now, it's actually quite possible, though, that we're in a topping formation. It's always a low probability betting on a liquidity event crash. Like, you can never assign, I know it's going to crash or something like this. But, it could happen.
At least not on this podcast.
No, not on this podcast. But it could happen. But I suspect, just like what happened in 2007, was that even though there were already issues, the market still managed in October 2007 to rally to a higher high. Well, I don't necessarily think we have to rally to a higher high. I'm also not 100% convinced that this is all downside from here. With that said, there's a very important line in the sand for me, and that's the Fibonacci zones in the 4,300 area. If this is simply a zigzagging corrective pattern, we should see in the next 50, 60 S&P points a swing low. And more importantly, if the bulls have any chance, they're going to have to deeply reverse the post-FOMC 2 days of selling, like where we get back towards 4,500, maybe by even the end of next week. If we see that, then maybe we're going to have a topping formation where we go and double top retest highs and it creates a topping. But if 4,300 gives out, I consider that to be shit hitting the fan, because when we're below 4,300, that's probably what's going to cause the VIX to get up into the mid 20s. Right? Like right now, we're still in the teens, like 16. It's not like the market's not yet nervous about this drop. And
I agree, Patrick. It's actually, I would argue the market's a lot more nervous about bonds than they are about stocks.
Yeah. And to me, below 4,300 is where we see that 25 VIX. And we start seeing, people grabbing at vol premiums to hedge things out and degross risk and create that kind of feedback mechanism that could really start the downside. And so right now, if 4,300 holds, I'm not yet actually super bearish. I think that there's a very reasonable chance that the bulls may be able to swing it by, but I do think at the same time, it's very possible now that the highs of the year are in for the stock market. The idea that we're
2
going
months away or whatever.
What?
We're 2.5 months away from the end of the year.
But the point is that that July high will probably hold this year. like even if we go for a double top retest and we have a 200-300 S&P point rip in a strong kind of equity recovery kind of move, I still think that it's a bad asymmetric trade to be aggressively long this market. I don't think you have to panic sell today if 4,300 holds, but at the same time, I don't know what is going to motivate me to go long equity other than for a swing trade to clip 200 points.
This is probably a rare kind of occurrence when I'm actually more bearish than you.
You are. Well, let's talk about those things that actually look really bearish. Number one, equal weight S&P 500. Look at how it is massively doing worse than the main S&P. The Magnificent Seven, while everyone is focusing on them as the one that's going to break, but really the broader stock market is sucking. It's it's actually legitimately breaking down, and like we could end up retesting year lows on the equal weight S&P, and that could happen like within weeks.
Right now, you're going to talk about small caps because
I got the small caps right here. So the small caps look exactly the same. Look at that decisive breakdown. I mean, at this stage, it looks like those March and May lows could end up being tested here within days.
Okay, I highlighted it in my letter the other day.
Okay,
Vincent
I didn't
Deloard, I know. Of course you didn't read it. Vincent Deloard from Stone FX, or I think that's the name of it.
Isn't it Stone X?
Stone X? Oh, I added an F. You're right. Stone X. Anyways, Vincent had a great chart. He actually highlighted the Russell Micro Index. Have you ever heard of this?
No.
See if you can, like, how do you get it on there? I'll see if I get you the symbol on the Bloomberg.
Yeah, try
this thing. Wait, Russell Micro. It's R Micro on the Bloomberg. I don't know how you're going to do it. M-R-M-I. No. Okay, it's micro cap. See?
This one?
There it is. I see it below, the second one there.
Yeah, the Micro E-mini Russell here.
No. That's the Russell 2000. Do it again. Oh. You're almost there, Patrick.
Oh, patience.
Russell.
Oh, I did it the opposite. Hey, hold on. Russell. Yeah. Look at me making a fool of myself here.
That's all right.
I do that all the time.
It's a regular occurrence. There it is. The second one. That one there. That index.
Yeah. Look at it.
Okay. Pull this back and look at it over the last 5 years.
That's so bearish.
It's a terrible looking chart.
More importantly, it's right along its 2022-20. It looks like a bond chart. It looks like it's
it's just awful.
And so that goes to this chart. So this chart I have here, which is the New York Stock Exchange breadth of measuring the number of stocks on the or percentage of stocks on the New York Stock Exchange that are above their 50-day moving averages. We're down to 27%. I mean, it's almost at levels where markets have typically bottomed because the selling is so intense. And here we are at 27%, and the VIX is still at 16 because no one's worried about nothing.
Right. And they just keep, and you know what's funny, Patrick? I've noticed this on the days when you get a big like risk off like morning.
Yeah.
Like everyone wakes up and they're like selling stocks. What happens is a lot of times you get a situation where everything is down, and then you'll see the Mag 7 rallying, and you'll see the Russell and the other stuff getting sold. And I am convinced that in some ways, the Mag 7's become a risk off trade. So it's risk on and risk off. It's hilarious.
Like I was talking with Chase about it earlier this week when we were doing the talking charts. And do you think the sector rotation will happen where the rotation into the defensives actually becomes a thing? Because right now, I mean, fine, some utilities bounced and other things, but really almost all of the defensive have been on the lower spectrum of the performance scale in terms of it's all the cyclical stuff that was performing well in the last 3 months. And so, like, do you think there's going to be a situation here where people will de-risk the cyclical names and move into some of these defensive names, healthcare, utils, staples?
I don't know, Patrick. I really don't know. I feel like it's very difficult. Like they're gonna, if we ever get selling in Mag 7, what are they gonna do with it? And I don't know. I'll tell you one thing that I actually do believe is gonna lead when we finally get the risk off event. It's gonna be gold and gold miners. I think they're already starting to act better. And
I love gold, but I still think that if we have risk off, these are still vulnerable to sympathy selling as there's liquidation. Though I do believe there's going to be a great bull run in this space. It's just right now they do look like shit, dude.
Well, yeah, but I think the fact that they look like shit means that nobody owns them, and in fact might be.
This looks like a bear flag that's below its 50% retracement that can easily go down $25 during a sell cycle. It's too early. Listen, dude. I love gold and gold miners. When this chart turns bullish, I'm going to be like way overweight this. It's like I'm going to be long gold miners like Cuppy's long uranium. But the thing is, this chart is shit, and I'm not touching it yet. It's too early to be in this trade with high conviction. You can have skin in the game, but you got to have room to average your position and or build a new strong position when the charts actually start looking good. Let's talk crude oil though. Like, what a run.
Yeah.
Like, now the bigger, okay, so I had a target up into this 92 to 94 zone. It's where the highs came in from October and November, but also there's some different, technical measured moves that are coming in there. So oil's pausing here, but this is still an incredibly bullish looking chart. Like in terms of the fact that we went through a year plus, bear market. It created a basing formation that lasted almost 6 months, and we're now breaking into new highs for 2023. Like obviously we're not clearing 2022 highs, but it's on the right side of that trend. And what will be interesting is whether or not we can make it all the way to the 100 level. I don't think it's going to go there in a straight line. We could easily pull back to 85 or 84 on a quick retrace, but I think old dips should be bought. I think there's a good shot that this thing gets up there.
Well, when it comes to crude oil, as much as I respect your opinion, Patrick, there's someone who I respect more, which is Mark Fisher. And Mark Fisher was on CNBC the other day, and he talked about the fact that although he agrees with you, the dip should be bought, he thinks the next $5 is lower, not higher.
Yeah, we had the retrace for sure. No, that moved down to 84, 85. No, that's a fib retrace, but that should be bought. Not like
right.
It's too short term overbought to be chasing up here. But if there's dips, you got to buy dips. I agree with this statement. And anyway, I wanted to I guess we got to talk about how weak the copper chart is. Just rolling right over. I'm going to say it. So just to piss you off, Dr. Copper.
Oh, God.
Exactly. Dr. Copper says everyone's
with the
sick.
PhD in the economics.
It says the economy is sick, buddy.
You got to do then you can do the copper versus gold trade like Gundy.
Yeah.
Like unlock. Okay. Anyways, what are you thinking about the PhD
no, it's just
it's
an awful chart, and I think it could hit 3 1/4. It's
my
awful.
God, that's bearish.
No, it's an awful chart, and if you think about where we are in the economic cycle, look, there is every reason to be bullish copper over the long term. Right, like there is going to be an energy, the way that we're going to need it for all sorts of different things. But we're in this economic cycle where we are and what's going on and the way this chart looks. It looks like it's got to first go back down before it goes higher.
Well, I like it, Patrick. You're sticking your neck out.
All right. The other thing is we got to talk about this uranium.
Oh yeah.
Like
I don't know. I got to listen to Cuppy every day, so.
But this U308,
he's nailed it, by the way.
Oh,
Good
he
for
has.
him. Yeah,
Yeah,
like
no.
it's just been an absolute
Rock star.
fantastic trade. Yeah.
And but this but you know, there's been a number, like Chase has been bullish uranium, a bunch of
I
like
agree.
but
I'm not good.
but Cuppy's really like made it known that he's like all in, right?
I don't know if anyone was as irresponsible with their portfolio.
Yeah,
as percentage of their assets as Guppy, but anyway.
But what a chart! It's now like cleared those highs from 2022, and we're at 66.95 on the U308, and it looks bullish. Like now, first of all, it does look like it's like oil, that it looks like it needs a pullback, right? It needs to take a break so that dips can be bought, but it is meant, you can't go short. You got to buy dips.
Yeah, you can't short it. But Patrick, it reminds me of the best markets, the ones that you always want to buy on a dip. They never dip.
Well, you know, that's why you
like
can't.
You said it, and I thought to myself, "Oh yeah, I'd love to buy this thing if it dipped." And I thought, "Oh Jesus, the fact that I'm saying that probably means it's not going to dip."
Well, you know what? That's why you have to have a core position, right? It's sort of the way I always look at it is like when it dips, you add. When it rips, you take some off, but you have a core position just in case it just doesn't quit.
Or you just keep adding like Cuppy.
More. I need more.
That's right.
All right. I wanted to just touch on one thing. I am finding it so bizarre that treasuries are having their faces ripped off, right? And these junk bonds, while they're weak, are not selling anywhere remotely as on a relative basis as the treasuries are.
Well,
and
don't forget the junk and high yield are what the duration's 5 years or whatever.
Right, and the 2 year did make a lower low, but the 5 year did.
You should really be comparing it to IEF as opposed to TLC.
Just look. All you have to look at is the credit spread, because that tells you relative to treasury. It's at a fresh low, dude.
Yeah, no, I get it. I think
like, what the hell?
You know,
this doesn't make any sense.
Well, no, I disagree with you there. That it doesn't make any sense. Like if you go back and you look at 2020 and you looked at how much corporate issuance there was.
Okay.
It was out of this world. And then you think about it, most corporations borrow for 5 years. And you go look at the
but lower grade debt
look
can't borrow five.
Well, I think a lot of those guys, you know, depending on, usually corporations are.
You think the triple C's were borrowing for fives?
I don't know about the triple C's, but a lot of
if you're a double B, of course.
So and so if you look at the 5 year yield, it was what 50 basis points for most of 2020. So they borrowed for 2.5, and the reality is, until that money comes due, there's not a lot of pressure on them. And then you combine it with the fact that the index has got a lot of energy. It's got a lot of energy in there. So there's a lot of energy debt that's trading better.
The reason
I'm with you, Patrick. I think it's coming. I think this is going to be the next shoe to drop.
I think so too.
And I think that if you're really bearish on stocks, you should be watching this like a hawk, because
agreed.
It's
my number one canary in the coal mine.
It'll come here first. You'll see it here. But I think it's here. I think it's coming.
But maybe that's why the stock market may not crash yet. Like, I mean, you're more bearish, but but you know, this is where maybe the theme of the remainder of the year is one big stock market topping formation rather than a stock market that is decisively downtrending.
Yeah, could be. I'm not going to disagree, but I think that it's not as much a mystery as you might guess, these the corporate spreads, but it's also something that's inevitably going to widen out. All right. I think there will be a lot of pain there.
We are going to introduce our new segment, Kev.
Well, it's kind of a segment within a segment.
It's a segment within a segment. It's Krayons with Kev. This is where you're going to take a stab at a chart here, buddy. So
yes, and then you're going to critique my technical analysis.
Oh, that's a lot of pressure. That puts me in a position of authority. I'm not sure.
Yes, well, you are an authority when it comes to this.
Well, maybe on the crayon chewing part, but that's
right. So that's what we're going to talk about. So listen, I was thinking about it because we don't actually know what each other's going to speak about. So I decided I'm not going to do like any indexes or something. I'm going to pick an individual stock when I do crayons with Kev. So we're going to do Ford.
Okay. Do some analysis, buddy.
And then I want you to put it out. I want you to widen it out for 5 years.
5 years? Okay.
And I want you to add the 200 day.
Well, 200 week then.
No,
well,
I
could put it on the daily chart. Here, I'll put on a 200 day simple moving average.
Yeah.
Okay.
Which is Paul Tudor Jones. He always says never.
All right.
Never buy anything below the 200 day. Never sell anything above it.
All right, there you go. You got the 200 day going out to 2018.
So I look at this chart and it looks like shit to me. Like that is a 1, 2, 3, 4, 5, 6, a sextuplet bottom that it's trying to make. It's trading below the 200 day moving average. It tried to bunch up, come here in June. It went above it, but it was quickly slammed. To me, this looks like something that's going to resolve on the downside. And I don't know, you can measure out your fibs or whatever it is. I think it's headed, it could easily go from 12.5 to 6.
Good job, buddy.
Really?
Yeah, no, this is a very bearish chart. I mean, it more or less there's these, for every primary move, there's the secondary reactions, right? Which are these retracements and things. And so we're bouncing from the fact that this thing has dropped from 15.5 to 11.5 in a month, right? And so it's going to retrace, maybe even prints 13 temporarily on the upside on a little bit of an uptick. But generally, this is a stock that's being very clearly distributed. And when this, it at some point is going to take a legitimate stab at those major lows. And when it does, it might give out. And I think a downside target, maybe 6 is a little ambitious, but definitely something like $8 on the downside. Clearing of $10 would be a very reasonable target. But then again, it's also time frame, right? Like if you're going, a multiple legged lower iteration, then yeah, maybe $6 might happen. But I think for an immediate downside target over the next couple months, if the market gets really wobbly, would be something under $10, like 10 and 9, $8 type of thing.
Well, there we go.
All right, Kev, good job, buddy.
I have no idea about the fundamentals. I just was looking at that chart and I was like, this thing's looking ugly.
Well,
and
good
ultimately,
job.
It's there's no such thing as triple bottoms or, 6 bottoms. The more something's tested, the more I believe that it's not going to hold. And to me, it just looks like that thing just keeps testing and testing and testing. It wants to break through.
Yeah, buddy.
All right.
It's time for my favorite segment all of a sudden. Skin in the game.
I am so bitter about this.
I love it. I love it because you fell on your own sword.
I was an idiot. Yeah.
You basically literally I laid it up for you.
Yeah.
So all you had to do was stay
with what I believed in.
Yeah.
And I didn't. I got cute. I completely.
So
blew
basically, we bet on the 10-year Treasury note at the 110 level, and you bet higher. Betting on that
higher.
bounce.
I had the choice.
To be honest, I wanted higher too.
I know you did, and that's what really pisses me off is that I got overthought it and I screwed up. I am like the Leafs when they played, Boston in that first round, and they were up in the final 7th game, and they were up 3-1 and going into the final, or maybe 4-1 in the third period, and it was all done, and I just keep choking and making a mess, and I feel the pressure because
this is you being the Toronto Maple Leafs. Let's see let's see if you can close.
So wait, what was it? 49-39 I had you?
Yeah. And so
then I wasn't allowed because of the rules. I wasn't allowed to bet 1s, and I had to bet 4s and 5s.
Yeah.
And here we are. And you know what? That one episode where you took the episode off, that's actually going to be important, because had you done that episode, it would have been a 4, and then you would have been a tied.
Yeah.
So that was kind of shrewd on your part to be so lazy and go to Croatia. Anyways, I listen.
So the score is 45-49, but listen, it's important for people to know that because of the rule we implemented, the next bet is 5 points, which is guaranteed. The next episode, we're gonna have a winner.
I know.
It's
whoever that was, I can't remember. But
great, I love it. I think no curse on him. That was the best thing. Okay, so Kev,
it definitely adds some excitement, because otherwise it would have been boring. I would have just chipped away. And now all of a sudden you're back in
50 chance right now that
Okay, let me
that
tell
you're gonna
people
win.
about the game.
All
Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants, and it's up to 50 points, and then at which point we're going to take out 3 lucky or unlucky listeners, depending on how you view it. And unfortunately, we had agreed, because it was going too slow and I was chipping away, playing it safe, that we were going to do 3 in July, 4 in August, and 5 in September. So therefore, we have to bet 5 this point. I am now 49 to 45. So this means this is winner take all. This is the bet. And
This is the bet.
Patrick gets to choose it.
I get to choose it, and I'm going to go and make this as basically simple as I possibly can. U.S. dollar yen, buddy.
Oh, God.
U.S. dollar yen over under right here, right now, 148.28.
Okay. Well, that was a very honorable way to end this. I'm going to take under, yen strength.
Okay. So I'm long the U.S. dollar. You're long the yen.
Yeah. So I'm betting under at 148.27.
Yeah.
Okay.
Buddy, that's it. This is going to close it. The U.S. dollar yen.
Jeez. So I'm going to have the double indignity of losing on my yen position and losing to you if the yen goes weaker.
This is fantastic. I can't think of it. This is fantastic.
I must say, I curse the reader or listener that made those rules, but for entertainment value, he was spot on correct, and it has made it immensely more entertaining. Because Patrick, you bugger, I had chipped away, I had played a safe game, and then just you had opened it up and pulled your goalie and done all sorts of crazy shit at the end, and you won. And not only that, I scored an own goal. I scored on
your own net.
I did. It was an amateur move. I shouldn't have. And that's why I said to myself, whenever he gives me this one, I'm just taking what I believe in over the longer run, and I'm not getting cute. I'm not going to think it through. And so I'm glad you chose yen, because it was an easy choice for me.
Yeah, I knew exactly what you wanted, and I personally, I'm happy to be along the U.S. dollar against the yen. So let's see what happens.
Okay.
All right. Now this is part where Lena has to come on and save us.
What a nail biter, guys.
Oh.
I'm at the edge of my seat.
All right.
I think you were the one who that kind of put that rule through.
I mean,
so I'm also a curse on you.
I love it. And no cursing him.
Yeah, there's no cursing.
Okay.
Should we get to the questions?
All right. It's time for no stupid questions. All right. So now, first one, though, Alina, the first one was actually a repeat of last week's, the one from 2 weeks ago, because Kev wants a second stab at this, right, Kev?
Yes, I do. And listen, let's not read it again because it was long. But in essence, the question was about 1 year forward on the Japanese yen, and someone buying, yen kind of 2-year bills or 1-year bills and then hedging it. And when I responded, I started talking about the fact that a lot of people go and they buy 10-year paper and then hedge for 1 year. And I'm always kind of surprised about that because there's a lot of duration mismatch and there seems like a lot of risk on that. And then I was lucky enough to have, a listener that's way smarter than me, and Matthew K. He reached out to me and explained to me what I had missed. And in essence, there is an arbitrage opportunity. Whereas if you go and you were, for example, to buy 1 year or 2-year Japanese yen bills, and then do this kind of hedging through the bank, you can actually pick up over U.S. government T-bills. And you can see that pickup if you go, and if you want, for people that are interested, you can go and pull up FXFA on your Bloomberg, and you can see that, and you'll see that the pickup in terms of various near maturities. And the reason that exists is that there's sometimes, a desire for U.S. cash, and there's a little bit of an arb there, so they can go and pick up 30 basis points, 40 basis points by doing that trade. And when you go look at some of them, like he was kind enough to show me a PIMCO account. And when you pulled up this PIMCO short duration account, you'll see that one of their top holdings is Japanese yen bills. But those Japanese yen bills are actually hedged into US dollars. So the long and short of it is I learn something all the time, and there is an arbitrage opportunity at the front end in terms of buying foreign bills and hedging them. And it has to do with just kind of the supply of dollars in the world. And it's way above my pay grade, but it definitely exists. But it's, we're talking 20, 30, 40 basis points. It's not something where you're earning dramatically more. And then plus there's always the bank risk on the other side, because you're truly not just government of Japan bills anymore. You're actually government Japan bills plus the credit risk from the bank.
All right. Let's go on. The second question, Lena.
All right. Hey, y'all. Big fan of the pod. It has really helped balance out my approach to the market as a newish retail junkie that got swept into the market with the meme stock bubble and unfortunately led to me catching the value disease. With all the chatter about how and when to get some long duration exposure into the portfolio, and with the entire tips current at over 2% reals. Is the tips ladder something to consider here? Context here is that it would be for my parents 5 to 6 years out from retirement, no cash flow needs until then. It just seems like a no-brainer for them at this point, or am I off in thinking that? In terms of expressing such a position, do you prefer dollar weighting duration exposure through some ETFs of different average durations, or just go ahead and build a ladder with single issues? Is there drawbacks to either route that jumps out to you? Thanks in advance. Keep up the great work.
So I'll take this, Patrick. This is actually a great idea. I saw someone on Twitter, a fixed income / macro junkie, talking about this exact idea the other day. So for those who don't know, TIPS is basically a bond that you get and you buy it with a yield, and you get the yield plus inflation. So if you had bought, let's say, in 2021, right before the big amount of inflation of 9%, if you had bought a 1-year tip that was yielding, let's say 1% at the time, although it was probably negative at the time, but let's just imagine it was 1%, you would have got 1% plus 9% on your actual inflation. And if you're thinking about it, the tips for the longest time were actually in negative, meaning that you would get inflation minus. But with Powell going and doing this, and with the bond market backing up so much, we're in a situation where we actually can get what this reader has kind of highlighted is actually a positive yield in a lot of the parts of the tips curve. So meaning you can go and buy, let's just say, a 10-year tip and get 2% plus inflation over those 10 years. And the reason you might do this as opposed to buying just a 10-year, treasury note at 4.5 or whatever it is that ultimately if we have another round of inflation at, 9%, or let's just say it averages 4 or 5% over the next decade, then you're protected against that inflation. So I'm all for people looking into this, thinking about this opportunity. It should be tips are much better than just owning nominals if you believe that inflation is the problem that we're going to face in the future, which is where I believe. I don't think that we're headed back to the Gary Schilling kind of Rosenberg, 0% forever kind of deflation. I think that we're going to struggle with inflation in the coming years. Yes, there'll be waves of it. It'll go back down. We might even have a year of, back down to 2 or 1%, but I suspect that'll be very quickly be met with some stimulus and with lower rates, and that'll cause inflation to perk back up. So I think that tips are a great example of how to do it.
Would you do it with single issues?
So
or would
I personally, if I was, having somebody that obviously everyone needs to go look at what's right for them. But when it comes to someone funding their retirement and that has a specific date that they need the money, I think you're always better off going and doing the specific issues. If you go and you buy like the TIPS ETF, you're going to be stuck with that duration, and that duration is going to continually roll into the future. Yeah. So I don't know what the duration is on the TIPS.
Yeah, like single ETF. Issue makes sense.
So just go buy the ladder of every issue that of every tenor that you need, and go through. And if you open yourself up an IB account, you'll go find that most of these tips, I hear complaints, oh, they're really liquid. And I pull them up and I go, it's 5 million up, kind of 10, 15, 20 cents wide. And yeah, it's not like a 30-year treasury that's, 10 million up, a 30-second wide. But it's still, in the grand scheme of things, it's cheap to trade these. And for everyone except, Warren Buffett, there's more than enough liquidity out there. Stick the order in the middle and wait for it and stuff. So I highly recommend that they go and take the time and just make themselves a ladder is what I think.
All right. Lena, next.
So next question I think is specifically for Kevin.
Oh.
Kevin, love the podcast. Wonderful guests, amazingly great questions when you do interviews, great banter between you and Patrick.
Aw.
In the past, you've been receptive to MMT. The last couple of years, we had a nice MMT binge, and now Fitch has downgraded U.S. debt, and inflation persists. As I understand from your podcast, the MMT prescription for inflation and debt is to raise taxes. By how much would you propose to raise taxes in order to address the current federal deficits and debt load? Whose taxes would you raise, given that most income taxes today are paid by the highest income earners, whose overall spending would be less affected by higher taxes than a lower income earner? Given all the lags involved, do you think that raising taxes in the face of a possible recession is good policy? Wondering how MMT works when it's not a sunny day.
I detect a note of see, I told you MMT wouldn't work in there. Thank you for the kind words at the beginning. Listen, when I said that I am MMT sympathetic, I've always said that the result of MMT will be inflation. And Patrick, and you've heard me say this forever, that I think that we're headed down this road and that MMT or MMT-like policies are inevitable or are at least very likely, and that the end result of that will be inflation. And that's part of the reason I've been one of the biggest bond bears out there and continue to be over the long run. I think inflation is here, and it's going to be extremely difficult to put that genie back in the bottle. Now, in terms of MMT, we have to kind of separate the way that the kind of descriptive part of MMT, meaning that if you do this, this is what happens to the economy, with the prescriptive part, meaning who do we choose to tax? How does all that work? And I've never had an opinion about any of those parts. And I've always said, I don't, like the left Greens have adopted MMT because it was a way for them to spend for what they thought was the climate, thing. And I've never been in that camp, in that I believe we should do MMT so that we can save the planet. I believe we should understand how the actual economy works. And I believe that MMT does the best job at explaining that. And there obviously is different choices in terms of who you tax and how that works. And I don't have the prescriptive part. But I will say this, I am extremely disappointed in the MMT folks for trying to blame the supply side of the equation when it comes to the recent inflation. And if we think back to 2020, when we were about to go into, lockdowns, and everyone said the economy was going to puke, that we're going to have a Great Depression, and just go back and listen to the podcast back then, there was all sorts of doom stuff. And yet the MMTers said, no, you can actually save the economy by spending. You can do all this. And no, we're not going to have a problem deflation. And we can basically, the government can plug the hole. And they were absolutely correct. The government did plug the hole. And it was a huge success. But the trouble was, it was way more than a huge success. They went way overboard. The U.S. government did 24% of their GDP in terms of fiscal stimulus. It's ridiculous that they did so much. They did way more. Like Canada, we only did 17, and I think the next closest was 18. So they did way more. They were just mailing checks to everyone. And not only that, after it was through, they continued it. We've kind of abandoned MMT, because if you actually listen to MMT, they'll say that once you have inflation, you have to cut back on the spending. And yet what they did was they went and they actually just continued on.
So wasn't that the skepticism that the governments could never?
But that's not MMT
follow?
Though. Just to be clear,
no, fair. But the thing
that's
is,
just the government doing fiscal and doing too much fiscal. So that's
but the
not
whole
MMT.
point, the whole skepticism of MMT is not the theory, but the fact it is theory.
So Patrick,
because
that's
in practice,
that's where I disagree. I disagree. There was all sorts of people who said we could never have inflation. Go back and listen to everybody in 2018, 2019, beginnings of 2020. They said we could not have inflation. They thought it was impossible.
Yeah, but that's not what the point I'm making. The point I'm making...
but that's my point, is that too many people thought that there was no way we could ever have inflation. And I always said, if there's the political will, we can have inflation. They can spend the money into existence. And I think that's been proven correct. And so, yes, now we're struggling with this kind of, we're spending too much. And Patrick, you know me, I've been a huge inflation bull because I don't think that they're going to pull back on the spending, and they're going to do too much. And if you want to argue about whether we should have never gone down this road because this was inevitable, then that's kind of a prescriptive decision. And I would even knowing where we end up today, I would still take this over the opposite, which is, 30% unemployment and people like struggling to feed themselves and things like that. So, but that's a different debate than the MMT debate. To me, the MMT debate is, were the kind of monetarists correct that you couldn't go and spend and make inflation, and they weren't. So anyways, that's my 2 cents about that.
All right. Well, Lena, where can people submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Now, I want to just mention one thing. First of all, we're very grateful for all the questions that come in. Keep sending them in. But there are a number of people that are sending in 1-page, 500-word questions. And unfortunately,
Patrick has trouble reading that many words.
Yeah, I can barely read the Macro Tourist newsletter as opposed to some of these questions. But if you want the question featured, the rule of thumb is try to keep it to like a reasonable paragraph. It's just easier for us. So those that want their questions featured, please do. And we always appreciate the side effects when people send them.
That's correct.
That's
something to
keep that going. All right.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on X or whatever that stupid thing is called at the Market Huddle. And you can listen to us on all the networks. All the 9 yards. Patrick, where can they find you, buddy? You
can follow me at bigpicturetrading.com and on Twitter at Patrick Ceresna. Where can they find you, buddy?
They go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy I'm going to try that again. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
All right.
Okay, so you got to rate this beer, Patrick. I am jealous.
Yeah, you know what?
I don't even know. Did I get one of these? Because I don't think I got one of these.
We've had this beer before.
Oh, yeah, Patrick's drinking mine. See, that's what's going on. He probably got two, and he's drinking mine.
That's probably actually what happened. I won't lie. That's probably the case. So, you know what? First of all, love the name, Dirty Little Freak. That's immediately catchy on that. The coconut in there is definitely something that's new and interesting that I haven't seen before. But overall, I kind of think about whether or not I would drink this beer again, and I think it's right down the middle. I really don't want to go out on a limb on this one. I'm going to just give it a 7.4. It's not bad, but I don't think I would buy it again. So it's
not sessionable.
It's not. Well, if you liked it, you could probably drink it sessionably. But
it's a beer sessionable for Patrick.
What's up with everyone?
I don't know. Is Lena back home?
Yeah, I'm back home.
Oh, okay. Yeah. What do you do with your dog, by the way, when you go on your excursions?
She goes to grandma camp.
Oh, grandma camp. What does grandma think about this?
Oh, she loves it.
Oh, that's good.
She comes back like a pound heavier. Yeah.
For a 10-pound dog.
So you know what's funny?
10-pound dog, and she comes
So
back.
I grew up and I had a Rottweiler. Very nice, sweet.
So did I, actually.
Did you really? Sweet,
yeah.
But he was a big guy. He was tall. He wasn't just one of these big round ones. But anyways, I think he was 120 pounds. He was big, tall Rottweiler. And my dad used to buy really cheap food. We used to go to the train station to buy it. And we used to buy this cheap food. It was probably mostly grain, stupid Rottweilers. Like, I don't want to eat this. And then we sent him to kennel when we went to Expo 86, I think, or maybe, I don't know where we went. Anyways, we went somewhere. And my dad told the guy, he says, oh, he self-feeds. And the trouble was that our Rottweiler actually liked the food a lot more. And he literally put on like 25 pounds.
Oh my God.
25 pounds?
It was like a lot. It was a lot. It was because we were gone for like, it was like one of those summer trips. And he just ate.
He wasn't self-feeding. He just didn't like the food.
Yeah.
That's awesome.
Oh, well, anyways.
Well, Rottweilers are crazy. Like ours
what was your
also,
Rottweiler's name, by the way?
Ria. So I didn't name it, but anyway, it is what it is. It was actually I was a kid back then. We're going back like 30 years or something. But it was
Why did
also
your folks
like
get one? Because that was an unusual dog back then.
Yeah, I'm not sure. I actually don't know the rationale, but all I know is the dog was 120 pounds as well.
Oh, really? You had a big one as well?
Yeah, just a huge one, and like when I watched what was that movie with where the dog says squirrel? That's a whole meme now. What's that cartoon that?
I don't know. There's a dog that turns into a squirrel.
No. The Up movie where the dog. Anyway, the point is that my sister, which was at the time like 8-9 years old, was taking the dog for a walk, and usually the dog is pretty well behaved and no problem. But this one squirrel just ran right in front of this Rottweiler, and this dog went for it like full throttle, and my sister's like an 8-year-old is being dragged behind, bouncing like literally like a rag doll, just like we're like, what the.
It's funny because we had the same experience. My dad got a harness and decided to stick us on a toboggan behind him. Same deal.
Squirrel.
You know what's funny though is that they're actually a working dog and they're not very good at hunting. And so our Rottweiler at our cottage would there was this hedgehog or groundhog or something that was like I guess it was a groundhog, and it had kind of like burrows in it, and it would pop up in holes. So we would pop up, the dog would run over there and look at it, and then the thing would pop up in another hole and just do it. And so he spent all summer chasing this groundhog, and then one of my dad's pals brought up this husky, and within an hour the groundhog was dead.
No.
Like that's like a real, like that's what a real wolf is like.
Yeah. Don't fuck with the huskies meal.
Don't fuck with the huskies.
Maybe your dog was playing like a whack-a-mole.
I don't know. They're just he wasn't. I don't think they're a working dog. They're not real hunters. Like the husky is a hunter.
They're actually, weren't they bred for military? Like for
I'm not sure.
But anyway, working dog, military dog, it's the same kind of thing.
So it's just they're just not made for like hunting things.
So cute, though.
Well, except you got to be trouble because now, like I used to walk up to any of them, but so many people breed them to be mean and tough now that they're not as reliable as they used to be.
Oh.
Like
but they've always been, they're like Doberman pinchers or whatever they're called. They're meant to be like guard dogs often.
Yeah, but I just find that, like, you know, I would go walk up to them and put my hand out and show I'm not scared, and I would walk up to almost any dog, and then one of them growled at me, and I was like, oh shit, I'm not doing that again. Like, this is a big dog. Like, like so I just
fuck that.
No, but it was like, you know, I thought, like, and the guy's like, oh, he doesn't like people. I'm like, well, dude, you can't have a 100-pound dog that doesn't like people.
Yeah.
Like, you know, that's the other problem is that when, like, if you have some little dog and it goes to the park and barks at someone and then bites them, it's not the end of the world. But if you have a 100-pound dog like that's meant to, like,
it's gonna maul someone.
So that's why I always think, like, we have a Newfoundland, and all the big ones, usually all, like, you look at the Bernese, the Newfoundland, what's the white one, the Great Pyrenees, they're always gentle giants. And the reality is, as I say, you can't be that big and not be a gentle giant because they'll put you down. You don't have a choice.
Yeah.
Oh.
There you go. Oh, well, anyways, I guess maybe why don't we call it a day? Because it's we're taping this at lunch. I should go back and do some trading. And, Patrick,
Sounds
good luck to you on the bet.
All right. Well,
win, buddy.
May the best man win.
Yeah.
All right. Have a good one, everyone.
Take care, everybody.